So just going through the process of if you came to see me about borrowing money, what would I ask for? The main thing is understanding your financial situation, and everybody's financial situation is different. We all have different expenses. A lot of those expenses we don't need to continue. The gym, for example, I don't think I ever went to the gym. You have other things such as superannuation, where you're paying into your KiwiSaver. That can be stopped once you've got yourself into a mortgage, because you may want to put that money towards paying your mortgage off. The return on that interest saving could be better on the return of what you're getting on your superannuation funds or your KiwiSaver. What we look at is saying, well, let's look at your expenses, and we run through your expenses from day-to-day living costs. As I said, the gym, the food, the petrol, the main living costs, power, water, gas. We will also sit there and add on an expense for what we consider will be the rates and the insurances to own a home. We also will ask you for your pay slips. Now, even though your bank account, be it with the BNZ or whichever bank you may be with, what goes into your bank account is probably less than what you actually are earning, because you're paying KiwiSaver, you might be paying off and taking some payments of direct debits of insurances coming out of your pay before we set into your bank account. For that reason, we actually say, look, give us your last couple of pay slips. We can look at what your pay is. We net that pay up, we take off those expenses, and we come up with this magical figure that we are able then to convert into, based on this surplus, this is how much you can borrow. With your deposit, there's your purchase price. Very, very simple. I actually did a loan for one of my colleagues just recently, and we have got a calculator. Sorry, was that me? We have got this calculator which 5-10 minutes, if you sat down and told me what your income is, what your expenses are, I can give you within 5 minutes an answer on how much you can borrow. Very, very simple. From there, we actually would need to get a pre-approval. It's extremely important that you do get a pre-approval before you actually look at finding a home. A lot of us like to jump on TradeMe, look at that dream home, and you sit back and find it, or wander through the Barfoot and Thompson windows and sit back and find a house that you love. What I don't want you to do is to fall in love with that home and then to find you can't afford it. So we will talk about what can you afford, or, as we've discussed tonight, adding incomes of family, colleagues, brothers, sisters, joining together. That may give you the ability to buy that dream home. So what we do, as I say, is that we will discuss what you can afford, we'll fill out a loan application form, and then we will give you what's called a pre-approval. The pre-approvals last from 60 days if your deposit's less than 20%, up to 90 days for a deposit more than 20%. Most people probably don't find a home within 60 and 90 days. In fact, I've got people that I'm looking after that's been on my books for about 9 months, and they just won't buy. And I think why they're not buying is that they're thinking too much with their head, and it's the people with the hearts that are buying the property. They go in there, they do all the stats, they find out what the house is worth, they do research, and they set a price figure. But then there's so many people out there that fall in love with a house on TradeMe, fall in love with a house through walking past the window, and they're willing to keep going. And that's what we've seen with the market, and that's probably why it's gone a little bit crazy out there. And I don't know if those customers of mine will buy for some time, because they're still too much thinking with their head. Where do I go to? Pre-approvals. So if your pre-approval expires after 60 days, 90 days, it's very easy to renew it. All we ask for is some updated information, give us some pay slips, give us some bank statements again, if you don't bank with the BNZ, and we'll just renew that for another 60 and 90 days, and we just keep rolling it over. One thing I would strongly suggest you do when you find that property is contact, for example, the BNZ. We've got a free service where we can do what's called an online valuation of that property. There's various apps out there and sites you may have seen through Facebook where you can jump on and say, what is your property worth? What we will do is actually plug that address into the property. It will spit out a price range, the highest price range of what is happening in your area for that sort of house versus the lowest price range. It will then give us a guesstimate. This is what your house is worth. We think it's going to be worth $700,000. Now, I'm not too sure what the science is behind it, but it's sort of accurate. But don't rely on it. It will also come up with what we call risk flags. And risk flags are if we understand or if we are aware that that property may have had weather tightness issues. No guarantee with what we see to say that the house is weather tight. Hence, you need to do your homework, probably by going and getting a builder's report. Most cases, the bank doesn't want one. It's for your own peace of mind to make sure that when you buy this house, the side of the house doesn't fall over. All right? So get a builder's report. Also, in most cases, we don't need a valuation. We'll just work off the sales and purchase agreement, make sure you haven't paid too much to this report that we've done. And we'll say, look, we'll accept that as being the value. But if you're borrowing if you have got a less than 20% deposit, we'll probably want a valuation just to check on that property, just to make sure it's worth what you paid. So that makes it very, very hard for people with less than 20% deposit to be able to buy at auction. One thing we don't want you doing is running around getting registered valuations on every house you see. $750, $1,000 a pop. Becomes too expensive. So for 20% deposit buyers, it's pretty easy to sit there and go to an auction because we have given you almost a guarantee that we will back you on that purchase. But with a less than 20% deposit, we're saying, look, we need a valuation just to check you haven't paid too much for it. So really you are looking more at negotiating, which is a house that's got a price on it, or the price by negotiation. Great thing about those is you're not up against 20 other people bidding. It's just you and the vendor. So depending on what your deposit level is, it will depend on whether the bank needs a valuation or not. But please use the bank's services of an online valuation. It just gives you a guesstimate of what we believe the house is worth and maybe any risks around weather tightness. Then once you've been successful with that purchase, I suppose what happens next? Well, your lawyer will want to get a letter from the BNZ saying that your loan's now unconditional. Fantastic. We will then sit with you and discuss loan structuring. And this is probably one of the most important things out there. And what I'll say is do not always go for the cheapest interest rate. The cheapest interest rates are normally our short-term fixed rates, 6 months, 12 months, 1 year, 2 years. I would sit down and say to you, what is your risk appetite? And what I mean by that is, if interest rates went up by 1%, 1.5%, 2%, what effect does that have on you in terms of your servicing ability? Prime example is my son bought a house 3 years ago. He was up to his maximum in terms of what he could afford to borrow. If interest rates had gone up by 2%, he'd be looking for a second job. Posting mail or cutting lawns or something or other. So I said to him, well, yes, we have got cheaper interest rates at 1 or 2 years, but spread your risk. And what I mean by that is we can have fixed interest rates up to 7 years. Yes, they're more expensive than rates for 2 years. But if you put some of your loan on 1, 2, 3, 5, 7 years, it means that your total borrowing is not coming up all at once when that rate may have increased. So by spreading the risk, it means that you only got a small portion of your loan coming up for maturity. In saying that, most people look at 2 years, but it may not be the best option for you. So just remember that in terms of what is your affordability. We always also suggest that you put a small amount on floating interest rate, and we have a product called Total Money, which is where your income, all your savings, that money that you are putting away perhaps for a holiday, we can use that to offset against your mortgage to save you interest. So that money is actually saving interest on your loan. A great product, something to look at, and we would definitely discuss that if you wanted to talk about housing finance. So a small portion, we're not talking about a big amount, 15, 20,000. Once we've done that loan structure, we then send our documentation to the lawyer. You go and sign the documents. We wait for settlement. The house is yours. You move in. We'll try and send you flowers. Can't guarantee that. Or a box of chocolates or some muffins. But certainly it's something that, getting into that first home, walking across that doorstep, your partner picks you up, carries you over. Right? Fantastic. Last thing, insurance. If I ask, what is your major asset that you're going to insure? Can I ask, Pats, what is your major asset if you own a home? House is your major asset. Your car is your major asset. So is your contents and all that jewellery that your partner buys you, major asset. the question that I say to my customers is, what allows you to have that major asset? Now, that major asset is your income. Without your income, you won't have the house, you won't be able to pay your bills, you won't have the car, and your partner will not continue to buy you jewellery. Hence, we talk about life income protection insurance. It's for that unforeseen circumstance, and that's something which is not if you're single, or if you're married, or if you've got children, for all different stages of your life, it's something that we do talk about. A colleague of mine some years ago, he said to me, Simon, if you were living in your house, you weren't working, your sole source of income was the ATM in the backyard. So you went down to the ATM, you got money out to pay your bills, to pay your food. Would you insure that ATM against theft, damage, rains that we had, flooding, and it doesn't work? Absolutely. He said to me, you are that ATM. So I think that's a great way to put it. Finally, look, I'd just like to say thank you very much. Logan and I are down the back. Please have a chat to us if you wish. Thank you.